Okay, so hi everyone, we have Abel Pacheco here today. It's a pleasure for me to host him. I've followed him for a while on LinkedIn, and he's the founder of 5T Commercial Real Estate. He's going to talk about how in 10 years he purchased 8 single-family properties, yet in less than 2 years he went from 8 to 800 leveraged commercial multifamily syndications, and I believe also some passive investments as well. So yeah, it's a pleasure to have you, Abel. So I look forward to your presentation, and anyone feel free to join in with any questions in the middle. We're going to do a more informal format. So I'm going to have my questions as well. And if you guys want to jump in at any time, feel free to do so. Or just if you're feeling shy, just put your questions on the chat. Either way. Okay, with that, I'm going to pass it on to you, Abel.
Hey, thanks, Stefan. Thank you very much for having me, and thank you very much for allowing me to speak at your meetup. I appreciate it. And I see a couple familiar faces and some new ones. Yeah, you're very welcome. I appreciate it. So good to see you all, and Miss Esty, Lance, and everyone else. Nice to meet you. If we haven't spoke yet, I'm excited to hopefully chat in the future. So yeah, the opportunity to speak like this is always fun. I'm usually asking a bunch of questions. So now I'm on the flip side of it. So for you all, I do feel very comfortable. Actually, I love engaging. So feel free either asking questions in the chat as I go through, or at the end, either which one, if it's a good question, we kind of get to the topic, we can run through it, and happy to help. But yeah, exactly like you mentioned, Stefan. So my name is Abel Pacheco. I am a commercial multifamily syndicator, and that's what I do today. I invest full time. I have a couple of side projects, always going. I've never been short of jobs or work, but I'm a commercial loan broker in addition to multifamily investing. So it definitely complements my day job, investing or finding or underwriting assets. All that works really well. I'm also a podcast host. So I probably have about 5 shows a week right now. I'm slowing down. I'm starting to push out maybe 3 a week now, but probably about 150 shows, and have interviewed some great individuals on there. Like Miss Esther's been one of our guests, and she fits right in among some of the top talent, like Grant Cardone and Sharon Lecter, the co-author of Rich Dad Poor Dad. So I've had the pleasure of interviewing some really amazing folks, and just really treat it as a learning opportunity for myself. So if anybody has any questions on the loan broker side, podcast hosting, raising capital, which we'll talk about in a minute, and then also just working deals here in Texas, happy to answer. And I'll kind of share that story, 8 to 800 a little bit. That's essentially where I went from as a single family investor first. I'm from San Antonio, Texas. I grew up in Corpus Christi, Texas, so near the beach. And then now I'm in the Alamo City, and buy deals here. So 2008, I read, maybe 2006-ish, right when that book came out, Rich Dad Poor Dad. It was one of the best ones that I've had read to that point. Kind of the eye opener, purple and yellow book. It's really solid. And, it just changed my paradigm on thinking on my trading time for money and how to create a business system. So I didn't really know what it meant. I was 26-ish. I just knew, okay, I should buy real estate. My dad was the second gen real estate investor. My grandma had the first house. They had like 7 or I think 8 aunts and uncles I had. So my brother and sister, and they were in a 1-bedroom house. So that was the first real estate investing generation. My dad had one real estate investment, which is his house and his rental. And that's what I remember growing up doing. Like, there was obviously no ACH or there was no electronic payments at that time. So he would take me, I'd go, and we'd collect rent. And I remember doing that on our house. We'd go there every month, on a Saturday or whatever the first was. And it was always cool because we'd go somewhere out to eat afterwards and go get a burger or fries. And on the way home, he would try to explain this to me. I was like 4 or 5. Hey, this is what we do. This is our old house. We used to live there. We rent it out. They make a little bit of money. I pay the mortgage, and the difference goes into, we're having some fries today. And I was like, yeah, this is awesome. I want to go do that. And somewhere subconsciously that stuck. And Rich Dad Poor Dad came out, and I go, okay, I got to go buy some houses. And the second book that I read before I made that investment was Ken McElroy's ABCs of Commercial Real Estate Investing. And that book, if you haven't read it, is really solid. It basically runs through what I do on a daily basis, I think, is syndicating deals, creating partnerships, leveraging brokers, leveraging all the expertise you have, top talent in commercial real estate to put together a deal. And I read this book, and I'm 26 years old. I think I had $4,000 or $5,000 in the bank. That's the most I've ever had at that point. And well, at one time when I wasn't investing into a business, I could talk about that later too, but just from my little personal checking account at the time, it was like, okay, I have this money. I don't have to reinvest it anywhere else. And I should buy a house. And actually it was between that or a motorcycle. And I test drove a motorcycle from some guy off Craigslist. And he told me he'd show me how to ride this motorcycle, and I dropped his bike. I felt so bad. I dropped it. I got into a little accident. I hurt my elbow and I hurt my knee, and I screwed this guy's bike up. I felt bad, but that was good for me, because I was like, okay, I'm definitely not buying a motorcycle. I'm going to crash. And I bought a single family house. And for 10 years, that's what I did. I bought single family houses. So it was me and my wife would save up $25,000, $30,000, buy a house. And it took me a while to get there. And then all of a sudden, in a couple of years time, we went from 8 to 800 doors with multifamily syndication. So I'm not 100% owner of 800 doors. I'm a very small fractional owner, or percentage of the whole portfolio. But as soon as I started investing in commercial real estate, I go, okay, this is how to create wealth, because I had been working in IT profession, and that IT profession went from a sales, kind of entry level lead generator, to a sales professional, and then yeah, go ahead.
There. So since you mentioned IT, I saw on your bio, actually, you had quite an extensive tech career before, like growing startups, sounds like, or at least growing tech products. If you want to share a little bit about that.
Yeah. It's so on that side, when I started in 2006, I came in as an entry level role, and I'm probably making 40, 50 grand, maybe ish. It was a pretty good, like, little lick after college. But what we were selling is IT hosting. So we were serving businesses that needed hosting. And hosting, for those that don't know, there's software. We're all using Zoom, software, websites. All the hosting is like the physical part of it: computers, servers, cooling, data centers, infrastructure, networking, all the physical gear. And we sold that as a service. And we did. My first quota was like $7K a month. We did pretty well as an individual. Then I led a team, and then I had a bigger team, bigger quota. As soon as I went to management, we went from $5 million to ended up scaling to 50 something million dollars a year. And we did that every single year. We acquired $50 million in new business. It was actually during that time that I made more money, and I was investing everything that I could in real estate. But thinking about Rich Dad Poor Dad's book, Ken McElroy's book on how to buy apartment buildings, the ABCs of real estate investing, that I reflected on all this stuff. And I had this huge limiting belief for 10 years that I can't buy commercial real estate. There's no way I'm ever going to do that. Because when I was 26, I shrunk down after reading that book, and I said, I can't do this. I can't buy. I have $3,000 in the bank to maybe put a down payment, but there's no way I have $3 million to put that down payment on a $10 million property. It's not going to happen. That mindset that I had till when I was 26, I carried it all the way till I was 38 till we invested in our first 128 unit apartment complex. And I tell you that because that limiting belief is what kept me from applying the knowledge that I already had in a $20 Ken McElroy book. That was like, if you just went and applied it, you can go do deals. And I had that mindset about me, and that was what kept me kind of from making that first $1 million, if you want to call it that way. So I remember that saying, if you've heard it, many of the world's millionaires are created by real estate. Well, I was investing in 10 years at that point, and I wasn't a millionaire. I had 8 properties and I still wasn't there. I looked around in my friends, and family, and I was the guy, I was the real estate guy because I had more properties than everybody else. And I go, well, I'm doing something wrong. And when I was talking to someone else, they go, oh, well, this is how I buy 100 doors a year, single family. I go, oh shoot, this is real. And then this is how I buy apartment buildings. And I was kind of, it all came back together, full circle to a mindset. The moment I said, you know what, these people are just like me. There's absolutely no difference between them and me. They're just taking action, and I'm afraid. I'm worried. I'm scared. It took me all that time to buy those houses. I was worried about losing it all. I'm still worried about losing it all. It's kind of funny. I think we're so far from that actually happening, but it feels like sometimes this next deal, what happens if I lose it all? It took so long to get there. And if I just keep pushing that fear aside is what I've kind of been doing, that as much as possible, having faith. And for me, it's faith in the Lord, but that hope and faith is what I kind of hold constant to. And the more that you can hold on to that, the easier it is to take the next action and the next action and the next action and do the next deal and the next deal. And then, man, so we found syndication and started raising capital and putting deals together. And we transitioned out of the corporate world. We had this huge year, $50 million a year. And I'm sitting in my he was not a CFO, but he's like the VP of finance, the VP of sales. And we're at this big, publicly traded company at one of those literal huge boardrooms, this huge table. And there's like 6 of us coming around. If it was back in the days, they would have been smoking cigars and kind of talking to me. But anyways, they were like, hey, you did really well last year. And I go, yeah, thank you very much. They're record year. And I go, man, thank you very much. You did amazing. And you know what you're going to get for that? There's a big smile on their face. You're going to get a quota increase. And I was like, you're being sarcastic, but you're like literally jabbing me in the side right now. And I go, well, am I going to get like a promotion or something, along with that? And they're like, no, man, you got a 20% increase. Good work. And everyone's chuckling at the table. And I go, well, I know what that 20% increase of commission is going to do. It's going to cut my pay by 20%. That means if I don't overperform another 20% and work even harder, then my pay is not going to grow. And even though I'm making millions and millions and millions of dollars for the company, that's what switched and said, I absolutely have to do something different. And that's what, the culmination of those 10 years, a little bit of my dad, a little bit of this rich dad, poor dad, a little bit of business systems, a little bit of my buddy doing the same thing and being able to relate to him because he used to work where I work. And then, just getting after it. And that kind of started multifamily syndication.
So Abel, did you first start with your passive, like limited partner investments, or did you jump in right away? And
yeah.
And what were your choices in terms of sponsors there? Like, who did you go with?
Yeah. Well, so yes, the first passive investment, 128 units. Second deal, 282 units. My wife got in a deal on her own as well. And at that time, I had not networked or didn't know that multifamily syndication was a thing. The only reason I knew about it is because my buddy was on Facebook filming this video of him walking through an apartment complex. And I was like, dude, I got to set up a meeting. I'm doing something wrong. You need to show me what's up. So anyways, he did that. And that's the reason I knew about multifamily syndication. I don't think I called it syndication. I just said, I'm investing in an apartment complex and it's in my backyard. I could drive to the property. And there was one individual. I couldn't read a pro forma. So I didn't know about, how to make assumptions or any kind of figure out even the 70-30 split on the equity and figure out how his reversion cap, the entry cap he's buying and the exit cap coming out, and what 3% rent growth meant or a 2% asset management fee. I didn't understand any of that. He just said, hey, if you put your money in, 5 years later, we're trying to double money. If we miss, coming a little lower. If we do better, we get a little bit more. And then I was like, I'm in, man. Let's go. I've been doing the same. It was actually a conversation with me and my wife, and I showed her the investment. She goes, "Well, I mean, that sounds good. We're investing 30, 40, 50K on a single family house. When those come up, it takes us a while, but this one doubles every 5 years. And the way I said it, if we put 100K in, that will double in 5 years. So it'll be 200K." And I was 38. So I said, by the time I'm 43, we'll have 200 grand. And by the time I'm 48, we'll have 400 grand. And by the time we're 52, we'll have 800 grand. And if we can let it ride one more time, 56, we'll have $1.6 million. And that's, two seeds, 50K a pop. I go, well, let's put it in. And if we lose it all, this is literally our conversation. If we lose it all, the worst case is I still got to go to work every day. I mean, that nothing's going to change that. And my wife is like, let's get it. Let's try it. Let's go. And then we see this PPM, private placement memorandum. It's like 90 something freaking pages of like legal docs. We had just created our own LLC. We're, starting to kind of do real estate more as a business, where before we were just buying in our own name. So don't let anything stop you. Just take action, right? But anyways, I'm looking at this whole doc and I go, what the heck is this? And my wife goes, do we need like a lawyer to look over the docs? So I go, well, he says he's going to fill up fast. And the first one that I tried to get into, I called him on, he's called me on Sunday. I'm going to send out a deal on Monday. I looked at it Monday. I talked it over with my wife on Tuesday. Wednesday, I said, hey, I'm in. I'm going to go in. And he goes, man, I'm sorry. We're two times oversubscribed. And I go, what? 2 times oversubscribed? Like, he needed 2 million. They raised, they had $4 million in commits in like the first 2 days. And I missed it. So the second one, I go, babe, if we have a lawyer look through all the stuff, we're going to miss the deal. And she was like, yeah, let's just go for it. And that was my first passive investment into commercial multifamily syndication. So I trusted the individual. The relationship was the most important thing at that time. I could see the property. I drove by, see what's going on. Okay, it's real, right? And then, let's trust the system, so to speak. I don't recommend that now, but that's what I did. The first deal, and then the second deal. And then my wife got in the third, and by that time I was in the deal and kind of starting to look through the pro formas. I get a feel for the execution plan, the business plan. I had started taking education at the same time. So I signed up for real estate class, training coaching program once, twice, 3, 4, 5, 6, probably 6 programs. And I don't know how many masterminds later, countless thousands of dollars, and traveled all over the country to obtain as much education as I could. So by the time I was doing a deal actively, I was like, oh, I've already gone through these emotions. Let's just keep going. Let me pause. Is that helpful, Stefan?
Yeah. So if you want, actually, Abel, if do you want to share about your first active deal, like how that went, like how did you go about capital raising? Was it more family and friends, or was it online, or
Yeah.
with other more experienced sponsors?
I did. So the same partner that I invested passively into was, my buddy that I asked, hey, will you coach me? Will you train me? Will you show me how you're doing this? And he goes, no, I don't have any time. I just don't have any time. But if you invest passively, you're going to learn through the process, and you're an owner. So I'm going to answer any question you have. So I said, okay, let's do it. So that process of me investing, I kind of set the stage a little bit that I'm going to ask some questions. And I did. I asked, a few questions here, a few questions there, looked at the next offering memorandums. But as I was taking education at the same time, what I started doing was telling everybody around me what the heck I was doing. And so I remember putting a a Facebook post like, "Hey, we started. Me and my wife started a new real estate business. We're going into commercial real estate investing." And because my friends kind of knew, oh, you're the single family guy, and anyways, as soon as I posted that, people were asking me, well, shoot, how'd you get into commercial real estate? And I said, well, I invested in our first 120 unit. And then we closed that deal as a passive investor. And I pushed that out. I published it out. I said, hey, me and my wife are part owners in this deal right here. And we branded it. We put our 5T, the logo that you see right here. If you go look on my Facebook post, you could probably see it if your friends are on LinkedIn. And you just go back and I put it out there and say, I'm a part owner in this freaking deal. And you're a limited partner. You're a fractional owner. Talk to the IRS. That's why you have a K1. You're a business owner, even if you're a limited partner. And people started asking me, how did I do that? And so those are my friends. Those are my people that I worked with in the tech company, people that I made a lot of money for. Either they were above me and my organization was cranking, or they were some of my sales guys on my sales teams that I helped them, hit their numbers, hit their quotas, hit their commissions, and everybody made money. So the way I've always served people or kind of framed myself as a servant leader was that if I help enough people, this is an old Zig Ziglar, I think something my dad shared with me that stuck with me. If you help enough people get what they want, you're going to get what you want also in return. And that's kind of the mindset of me serving people, helping people, get them education, get them trained, get them knowledge. In the sales world, that applied well because I was commission based too. The better they did, the better I did. And then I found that multifamily real estate was investing is the same way. My buddy helped me get education and knowledge, and I did better. And I'm helping my investors get some of that knowledge, and they get better. And ultimately, that first active deal was me sharing the passive investments for 6 to 9 months, or however long it was me passive, and finding out who was interested in learning more, and then educating them about the process that I was going through as a passive investor. And that helped me a ton because I had $250,000, good bit of capital that for me at that time, I'd never thought I could raise any money at all. But anyways, that came into my first deal, and I played, basically I rode shotgun, if you want to call it that way. Right. So the SEC won't let you raise capital and just do that's it. You have to have some kind of active role if you're a principal in a deal to raise capital. So what did I do? I did raise capital. I did do investor relations. I do, basically set the wheels in motion for capital to come in. But then there's so many things that need to be done on these deals. Like somebody's got to look through the. Oh yeah, go ahead.
Yeah. So just a question on the chat on what you're saying with regards to raising capital. So how long did it take you to raise capital for the first and subsequent investments as well? And did you ever use your own money for multifamily?
Mm-hmm. Yes, I used a lot of my own money. So the first deal, like the specifics, was 120 something units. It was a $2-ish million raise. Bought us 120 plus doors in San Antonio, Texas. It was that $2 million raise took us like 2.5 weeks. And I could have probably raised more, but it was already full. And the only reason it took us 2.5 weeks is my buddy knew, hey, I'm gonna let you get out there and go raise some capital first, because the moment he sent it out to his list, it got full. So I had like a week and a half in advance of him where he kept it quiet. I talked to some people. That was my week and a half, and it was me and one other partner that were on that newer side. And then as soon as he sent his email out, it was, that was 2.5 weeks and it was filled. That was not eye-opening. The eye-opening part was when I missed the first deal, was me saying, oh shoot, this, the capital comes in like really quickly for a good deal, just like that. Well, I'm going to move fast. And then being on the inside, raising capital from that, I think it was not shocking, but it was still a little surprising that it happened so quickly. So $2.5 million, and that's how it went. It was pretty quick. The second deal, or the second question is using my own money.
Yeah.
Oh,
So,
go ahead.
Certainly. So the portion that you capital raised besides your own funds, so that was sort of between yourself and the partner of yours.
Yeah, there was three principals in the deal, three general partners, and we all raised the capital together. He just gave us the little bit of leeway up front because he knew he was going to fill it up. So essentially, we got to try our legs, get our capital raise legs under us, and then I invested my own money. I kind of viewed it almost like a passive investment because I was still coming along for the ride. I don't know what the heck is going on. And I see all these attorney calls and I'm on the deals, trying to learn more, trying to figure out what's going on. I put my PFS together. First time I put a PFS together, my net worth, my liquidity, got to have that for the commercial loans. And now being a loan broker, that's kind of like the first thing you ask for. But anyways, that you put that together. I'm talking to the loan brokers. They're doing the background checks on me. Then we go through the lawyers. The lawyers are telling you, hey, this is everything you need, every single step. Then you get closer to the close. It's like a weekly call. And, you have the title, the insurance part of it. You have the property condition assessment. You have the engineer reports that go out. You have all the things, and the lenders are kind of doing their thing. Hey, did you put all this stuff together, giving them all the data points, everything that they need? And then we close the deal, and after that, it's the property manager does a lot of work, a takeover, took some pictures in front of the building, but I'm like boots on the ground. I'm here in San Antonio, so it's easy for me to play this role as boots on the ground, go drive by the property, do the unannounced, visit, pop in, check in, and see how things are going. And after that, just kind of learn along the way, right? That deal's, we have not gone full cycle. So that my first deal is 2019, and it's performing well during COVID. My partner's showing me a little bit on here's how to stay conservative, here's how to do the assumptions, and now great mentor, great coach. It just kind of helps me all the way through. And that was the first deal. Second deal was a little bigger. Second deal was 268 doors. It was an $8 million raise, a little longer than 2 weeks to raise that money. That one was like, wow, man, that I felt like Fast and Furious. There was more partners to raise that much capital, to do that much work. But still, sure enough, like the first, the first one, you find a great deal, you underwrite it, you stay conservative, you figure out how to build a good team around you. You find the funding, you get the financing. Execution is done, by the property managers and helping you with the construction management and renovation plans. And then you're, operating it and find a good team, and then just, move forward on the second one. And for me, it was like, I'm not leading these deals. Again, I mentioned kind of along for this ride, right? So I'm learning along through the process, right? So they're 5-year deals. So you kind of learn through, what you need to. I had that, I don't want to say privilege. I had the opportunity to do that because my partner was already the veteran or the expert. He'd already been doing deals, and he went from a co-sponsor to a lead sponsor. And so I highly recommend that path. Invest passively, put your money in it, know what it feels like, learn from everyone else, get your money invested. Then the second one is take a small percentage and go ride shotgun with someone else. You got to provide some value. You have to figure out what you're going to do. And I could talk about the value that I provided up to that point. But you got to provide some value so that you even get an invitation, right, to get into the deal. You got to get prepared in advance. You can't do these things when there's a deal under contract. It doesn't happen that way with 6 to 9 months of preparation before that first deal.
Speak to that part a bit. So what was your strategy for sort of having a value proposition to other the primary sponsors on your first and second deal?
Yeah. And this, I think, is a truly repeatable model if you want to go do the hard work. if you are built this way. Some people aren't, but if you are, it's a repeatable model, because I know anybody that came to me with this, I would go do again. So um, what I did was I tried to provide as much value as I possibly could to my partner that I was investing in passively. So I invested once, twice, three times with him. I put on social media and tagged him and said, "Man, this is an amazing opportunity. Thank you for allowing me to partner with you." Simple process, very straightforward. I love it. So essentially, I was a little bit of marketing for him, right? And tagging him, saying, "This is amazing. Be a referral." I was that for him. And then I maybe I kind of I didn't know if somewhere in me said this is going to be good exposure for me. So I'm kind of tagging together and saying, "Hey, we're partners. It's good." But I think about it now. For me, man, I'm like trying to be social. If you looked at my LinkedIn and Facebook, I'm trying to put out posts all the time. So if somebody tells me, "Hey, thank you very much for education, content, learning, whatever the fill in the blank," and tags me and puts me on social, I know I'm going to respond, even if I don't know you. But that's what I did for a little bit during those 6 to 9 months, because I was passively investing, right? Then I wanted to know what the investor calls were like. I wanted to know what he told somebody to, to raise capital. So what did I do? I introduced him to other investors. I didn't think that those were my investors, and I'm introducing them to him, and I want to hold them tight, and it wasn't a scarcity model. It was more like abundance. It was like, man, I want to learn how he's doing it. So let me just bring him some people that I think could invest in deals. And I want to sit at the table, literally sit at the lunch table, have a little networking, and I get to learn from him literally on the spot with real investors, people that I brought him that he sat down with, and I get to sit at that table, literally, right? And figuratively. So that was the second thing. The third thing was, he goes, "Hey man, I kind of thinking about starting a meetup. What do you think?" And I go, "I'm in. Sign me up. I'm ready for that." And I created the meetup. I think even before he had time to think about it, I created a meetup page, like you have, Stefan. Created it, marketed it, put it out on my social, set the date, blasted it out there, invited all my network to it. And now I'm like, oh shoot, I'm like Mr. Social. That was the first time that I really said, and I was working full time, W-2. That was the first time that I put something on my LinkedIn or Facebook that was not W-2 related. It kind of felt like, oh, are they going to fire me? Hopefully not. I was kind of that little worried, but anyways, we started a meetup, right? And I go, well, shoot, I don't know this content. And he goes, I got the content. Don't worry about it. If you want to do the meetup, invite everyone, let's get a crowd. That way I know if no one shows up, it's not going to be me alone. We'll be here hanging out. And I said, yeah, that's cool. And that's what we did. We promoted a meetup every single month for a year. And so there's that 6 to 9 month window where I'm social, I'm promoting him or tagging how great the opportunity was to partner together. Then I did the meetup, literalmeetup.com, and a physical in-person meetup. And we really didn't do Zoom virtual. This is pre-COVID, right? And then invited all the network. Well, what happened was, his reputation, his expertise, tenure, whatever you want to call it, started, rubbing off on this guy, right? Where people are like, "Oh, you're partnered together?" I'm like, "Yeah, I'm partnered on freaking 400 doors, and we're about to go on a 500 and a 700, and now 800, right?" Because I counted my passive with my active, and you all together, it was with the same team, same partners, and that created an opportunity where I could say, yeah, we partnered on 4 or 5 deals, 6 deals, 7 deals, right? And we kind of keep rolling. And that helped my track record, my tenure, my expertise. And then also listening to the individual telling other people how to do it. Obviously I get like free coaching, free education, free training, just like you're all here. I'm not saying necessarily just me, but every guest that you have at these meetups, you're learning for free. You need to soak it all up and then apply it. And so at that time, raising capital, bringing investors to them, helping start a meetup, driving traffic to them, man, I was like a freaking one man band trying to help him out. And, he may not have needed it, Mr. A couple $1 million raise in a couple days, but you have to believe, I had to believe that, man, that was pretty valuable looking back on it. And I haven't had anybody do that yet for me. So that's the reason I say, hey, this is very valuable. Now, a couple of people that I appreciate are getting close. A couple of them over here, actually, we're talking about it, that are on social, that promote, that kind of are getting into my world. I'm like, man, I want to go partner with you. I absolutely want to go partner with you because it feels like those are all the same things that I was doing. And I consider myself a great partner to my team. I'm trying to provide as much value as I can to whatever team I work with. So those are like the tactical things. Invest passively so you can say you're partnered. Promote them because you're promoting yourself too, as we're partnered together on these deals. Bring some other investors and have those conversations. And then if you can get, on some kind of meetup or some kind of event at least, or highlight or broadcast, and then you're there connected to, you're going to learn and get the exposure and get the connection and build your own reputation and track record along the way. So hopefully that's helpful.
Awesome. Yeah, that's a great story. And so you mentioned before with regards to like your initial thought processes for multifamily passive investing, let's say, where you were thinking of, okay, we can double your money every 5 years and like this kind of approach. So are you finding like your intuition, let's say, versus your prior single family investing? Like, do you feel you are making more money this way? Do you feel it was more profitable? It's a question on the chat.
Thank you for bringing that. Yeah, you make more money with less time. So it's simple answer. The long answer, I give you more explanation. But yeah, multifamily investing passively, you make more money with less time. Um, to give you an idea of my volume before I made a hard transition. So it took me those 10 years to buy 8 single family houses. That was me and my wife. That was before I knew about wholesaling, which I didn't do any. I didn't know about raising private capital. I didn't think to partner with anybody else. I didn't market for my own deals. I only looked off the MLS. And that's what I did for 10 years, right? So I go to education. I took some classes. I spent 20 grand. I traveled a bunch of different cities, and they teach me how to do that. Market for deals, wholesale, raise private capital, partner, and then go hit volume hard. So it took me the 10 years to buy 8 houses. In 1 year, we did 10 deals. That was 2018, I think. So we did 10 single family transactions. And I had a W-2 employee. I was a W-2 employee still at the end. I had a big old team. This is the $50 million year, right? And $50 million year at work. And then, we did those 10 transactions in 1 year. And what happened was that I spent so much time, effort, and energy and money, time, effort, energy, money, classes, course, all the things you think about, just to get 10 houses done in 1 year. When I looked at the math, the dollar amount, I made more dollars per hour at my W-2 job. I should have just stayed at work and I would have maybe produced $60 million instead of 50. And I probably would have had a better quality of life working from maybe 7 in the morning till 6. Because what I was doing was I was going in 8 to 5, cranking it out, maybe 8 to 6 sometimes at work. And then every day, Monday through Friday, and my Saturdays and Sundays and lunch hours, I was doing real estate. And so I don't 80 hours a week, I don't know, 90 hours, who knows? Well, probably more because I'm a night owl. I get off work and I'd come home and I didn't have any kids then either. So it was my wife, and she kind of knows that we'd started looking at houses, and that's what we'd start doing. And so I think about all the hours and then taxes. The tax man got me at the very end. I'm like, all right, we made some money. I got some money in hand. And then capital gains taxes, boom, slammed me. In multifamily, what I did was, my wife was the real estate professional. She finally got to stay at the house. So she stayed home. She managed our single family portfolio, and she had an active role. And so she was the real estate professional. We invested that 100K cash, and we had 60 something like $68,000 in losses because of cost segregations and accelerated depreciation. So my big fatty, my big commissions that the government was taking 40% off commissions and maybe 30% off of the regular hourly pay, actually instead wrote off all of those W-2 withholdings, and I paid no taxes, and I got a $30,000 refund that first year. So I go, well, shoot, my 100K is even more powerful because I was only expecting it to double in 5 years. Well, it was set to double in 5 years, but it also helped me avoid, $60,000 in taxes that I was literally paying. I was up to about 250, close to 300K when I finally left IT after those 12 years. So taxes was a good chunk of that 300K, and that helped me just completely avoid it. That was where I say more money with less time in multifamily passive investing. Now I'm active. I'm an active multifamily investor. Like here I go again, right? I'm pouring hours in. You have to count this as an hour. My podcast is an hour. Capital raising is an hour. Networking is an hour. You got to count all of that stuff if you're really active. But multifamily passive investing, it's amazing. It is amazing. Ultimately, I'm trying to build up enough active capital where I trade time for money, where we can go find deals, fund them, finance them, execute them, return everyone's capital, pull out my seed that's active, and I want to go invest it passively as I'm going active as well. I mean, that's my goal. How do I get, a couple $1 million passively invested at a 6-7% return, and just lays the track in front of itself. When one of the deals refinances, when one of them exits, just keep building the snowball in front of you. But not quite there yet. So I still have to actively get it on. So hopefully that helps.
Awesome. Yeah. So several questions on the chat. So first question, do you invest in Texas in commercial multifamily, since you mentioned you're in San Antonio, Texas right now? So
I do.
Locally, or do you go out of state?
I do. We've done 8 deals now. So as a general partner, principal, a fund manager, 8 deals. One of them is a fund that is a Reg D 506C fund. So I can just kind of feel comfortable talking about it a little bit. And that deal invests across 9 different markets. And it's a diversification play. And it's actually a way bigger fund being managed by some Fortune 500 company, big dogs. And we're a passive investor in that fund. And so we're a fund of funds, right? That one's outside of Texas because my investors kind of had asked, hey, are you going to give us any diversification outside of Texas, or what's going on? And, so maybe they didn't ask me directly, but I could feel them say that. So that's that one deal. We have another ground up development that we have not broken ground on, but God willing, by the end of this year, we'll break ground on 156 doors in New Mexico and Rio Rancho. Outside of those 2 deals, 6 other deals are in Texas. So we did San Antonio to start with, 100. That's kind of where I lived and did most of my investing. San Antonio, 124 units. San Antonio, 268 units. Then we did 120 units in Greenville, which is just outside of Dallas, DFW. Then we did an 88 unit in McAllen, Texas, which is about 3 hours south of San Antonio. And then we just closed on a 42 unit in Austin last week. And then we have a small percentage in an industrial warehouse or industrial portfolio. There's 3 properties, one in just outside of Austin, one in Michigan, and one in the Carolinas. So, we kind of focused on Texas multifamily, but I guess I gave myself permission. I said, well, if I've been investing in one market and since 2008, I'm going to give myself a little permission to go to a different market or 2. So yeah, but the ones we operate, we like them to be close as possible to us so we can drive them there in a day if we need to.
And what is the profit split structure? So another question on the chat. So do you And you do with the waterfall, like kind of 70-30/8 pref, or like what is the structure that you do?
And this is a fun one too, because I haven't done the same type all the way across. We've done 70-30 split, 70% to the investors, where the passive investors get the lion's share. We take the 30%. And we did a 7% preferred return. So that means, on a 100K investment, our passive investors got 7K roughly a year. And then we try to match the distribution to the pref so that they know, hey, this is going to be a regular payment that comes out monthly and quarterly, however that works out for each deal. And that one we've done a couple of times. We were also able to do another type of investment, which I really like a lot. It's a great model. I'm excited. It's just gonna see if we have enough investors that will follow us here. We did a 6% preferred return on the distribution, so 6%, and then a 6% on the equity. So it became a flat 12% without any upside, but it was 12% preferred return. So some people that wanted a more consistent payout, a more consistent distribution with a lower risk, a risk adjusted return, they're getting 12% preferred return. So I haven't seen anybody else do 12% pref on any of the deals that I've seen, but they don't have any upside. It's basically capped at 12, right? The reason we were able to do that, or one of the byproducts of that, is we have a nonprofit that's in that deal as a general partner, and so they're getting a piece of the general partner pie, and we get to fund this nonprofit as we go, which is really freaking fun for me and my wife, because we wanted to give back, we wanted to serve, we wanted to help, and these are the biggest checks we've been able to write to a single organization ever, other than us church, us giving to church. But so that model was a little different. And then our fund that we're doing right now also has a nonprofit in it, and it's a faith-based nonprofit, and they're getting like 15% of the GP. Well, that deal it's such a pro forma. We just kind of put like, there's so many assumptions to it. What are we buying? Where? What market? What submarket? All the deals are that we want to invest in are 250 unit deals, $30-40 million plus opportunities. It's literally like a $500 million fund, and it's called Waymaker. So that fund gave like a low, a medium, and a high, so people can at least just put some numbers together. But I kind of told all the investors, just kind of think of it as 12%. If you're okay with 12%, you're going to be happy. There's a lot of upside to it. And then if you want to still give to the nonprofit, which we really like. And then the most recent couple of deals, different structure. Again, it was a little bit, a mightier deal on a small one. It was like a 10% cash on cash return, or 10% distribution and an 8% preferred. So we had a lot, to kind of cash back. We're going to do a refinance, and we use a projection performance, but refinance in a couple of years, give half equity back of the capital right away. And so that's the most recent one. Another one has been a 6-year deal. Most of all the other ones are 5, but we did a 6-year deal also, and it was a 16%, overall average annual return, 6% pref. So before COVID, I would have told you I want everything at 17, 18, 19%. Now with COVID, I think people are getting a little more realistic on returns, and I am as well. I've done 8 deals, right? I want to do deal number 9. I want to do deal number 10, but with a little bit more experience, I want to make sure I'm getting paid a little bit better. So it's kind of, it's a little bit of a mix, I think, depending on where you catch a syndicator or an operator in their careers. My first deal caught me there. My 9th or 10th deal, it'll probably be a little different too. So that's kind of where I'm at right now. Hopefully that helps.
Awesome, that's great. And so you mentioned some of the education that you took actually at the beginning, like some of the courses.
Yeah.
So did you do like the syndication, like a multifamily syndication training, let's say?
Yeah.
Is there a specific sort of training program you can recommend?
I can. I can recommend them all actually. So not literally, but figuratively. So figuratively, every single training program that I've ever done in real estate has always provided me more education, more knowledge, more networking, or my next partnership or next deal opportunity. Every single time I said yes, it brought me a new deal or a new partnership, new investor, new education, or new insight. Every single one of them. Now, I would caution you, don't just jump in if you're not going to take action. Otherwise, you're just spending money, and you might as well just go to some meetups or listen to podcasts if you're not going to act, right? But if you're going to act, then that's where I think at least one program will absolutely help you. So I'll go through my programs, right? I started with Rich Dad Poor Dads. It was elite legacy training, which I don't recommend for multifamily investing, not for syndication. They have a commercial classes. I learned about like all commercial, not just multifamily. And I learned about syndication, but it wasn't just multifamily syndication. It was like warehouses, retail, land development, raising capital, owner finance and creative financing, commercial real estate, which was really great. All that stuff like helped me even in our industrial warehouse portfolio, just kind of broaden the perspective. But 80-90% of it is like single family houses. So the reason I did those 10 deals in a year was because I signed up for that program and I applied their training in action, and where it took me 10 years. And then 1 year I did 10 deals, right? So that's Rich Dad Poor Dad. It was probably like 20 G's. It was a good chunk of change. It was like for a year, and then not counting all the travel to every single city I had to go to. So that's fun. Then I took that and I went to Brad Sumrock's training. He's a Dallas operator, Dallas guy, and they have Apartment Investor Mastery. And Apartment Investor Mastery was really good. They have a foundational class. I don't know what the cost is now, but I think it's like 10K, and it's a bunch of videos. And you just take a bunch of videos and you have access to them for a couple of years. But what's really beneficial is that was my first time that I had gone to a networking event where I saw like 800, 600 people all investing in multifamily. So like all of a sudden my mind is open. Like there's all these people doing it. It's got to be real. Right? It's not just my one buddy, but there's 800 other people that are all looking for the same. So that class was good. I think his mentorship program is a little bit more, like 30 G's or something. But the pro and the con: great education, good for mindset, good for networking. There's a bunch of people that all want to invest in deals and go find it. But it's a closed network. So in other words, if you pay for the program, you can only raise capital in the group if you sign up for the $30,000 program, and you can't be a general partner on a team with another individual unless all the general partners have signed up for the program. So my one buddy that was not in the program, I was like, well, that means I can't do deals with him. So I kind of like, I took the training and education for what it was. And then I found that the next program, and then I went to, so those I joined. Then I went to a multitude of weekend seminars, which are very affordable, very cost effective, to get the same kind of education. But I went to Rod Cleef's boot camp 3 times. And then I've gone to Adam Adams Raising Money Summit once. And then I've gone to, I'm missing a couple, but those weekend seminars, like it's not the full, it's not the $30,000 program, but it's like the entry. It's the Thursday, Friday, Saturday weekend. You get the networking, you get the education, you get all this insight. And then, if you want to sign up on a mentor program, go for it. I recommend at least joining like one good one. Go in eyes open, learn a little bit more, find out who's in the network, see what you want to like, for what reasons. But those absolutely helped me. Then I did Apartment Educators here in San Antonio, smaller local group, not 600, 800 people, but like 20 that all just want to go do some deals here in Texas. And I'm like, I'm in that one too. And 15K is what that program is. I kind of joined that one. Some programs are bigger, 800 people. You probably won't ever really get other than some stage time listening to the person. And some of those groups are smaller, where the leader or the educator is going to, like, he'll be a key principal with you, right? And that's a value in of itself. If you're like, well, I don't know who the key principal is, well, shoot, you need key principal, net worth, liquidity, somebody to help you go do the deals, help you go do them. That's valuable. And also some education programs are like specific to markets, right? So like apartment educators we're doing deals in Texas, a lot of us, but there's other groups, people that have come on my podcast, they have education groups, but they're doing deals in the Northeast. They're doing deals, in a specific area. And so you want to ask those questions too, because it depends on where you want to invest in. Well, where's the network? Where's the network going to take you? Right. And that was helpful. And then I joined a number of masterminds. I joined a Kingdom REI mastermind. And that's Christian real estate group of multifamily guys and gals. Sorry if I say guys, women and guys. But in that mindset, it's like, well, other people that are aligned with my alignment of vision and my goals and dreams, aspirations of how I want to go do my business. Well, other people, you're just, again, sharing a little bit of mindset. And that mastermind led me to other partners, other deals, other teams. And then there's another AE mastermind that we started just last year. And then I have a local mastermind, 2 or 3 or 4 guys that we've been meeting every other week since COVID, right? So like every single time I've said yes to a program, education, class, a course, a weekend, I've met new investors, I've met new partners. They've led me to deals. And what I've learned is you say yes, as often as you can. When you say no, you don't say no to an opportunity. You say no to an offer. And there's a difference, because when I was in my tech role for 13 years or however many years, 12, 13 years, whatever, I didn't take any of the recruiters' calls because I was having so much fun at work, making, selling millions and millions of dollars. I had recruiters like constantly ping me for 10 years. And I didn't even talk to them. I was like, I'm having fun. I'm not going to talk to this recruiter. I may have passed in one of the best opportunities of a lifetime. I just don't know it, because I said no to an opportunity, as opposed to saying, you know what, you're talking about partnership in a new deal, a new market. Let's, yeah, I'm interested in learning about this opportunity. What's going on with that? I'm interested in learning about this education course. Let's check it out. When you say no when there's an offer in writing on paper that says, here's the opportunity you have to either partner at this percentage or this payout or whatever. That's when you say no. And that's what I've realized. I've been more open in the past few years to opportunities. And when I say no, I say no to an offer in writing and paper. Does that make sense? Hopefully that has helped a little bit for the education and training, probably more than you bargained for, but I get excited on this stuff. And
that was actually quite an exhaustive list. That's great. That's awesome. I'm sure that's helping our audience a lot. And another question actually on the financing we have. So Nick is asking in the chat, do you need property stabilization first to get the bank's interest to help fund capital, or do you use mainly hard money lenders? I would think it's primarily stabilized properties you guys invest in, other than the new development project you mentioned. Is that the case?
It's a mixture. Let's see. So in multifamily, the term for hard money lender is a bridge. It's a bridge loan. And so in single family, they say hard money lenders. In multifamily, they call it a bridge. And it literally is a bridge to go from an unstabilized property to a stabilized property. So on the stabilization part of it, they say 90% for the past 90 days, the property is officially stable. When you have a stabilized property, you can have non-recourse debt from like agencies like Fannie, Freddie, that will give you super low interest rates, that will give you a fixed rate across the term, and 30-year amortization over a 5, 7, or even longer, a longer deal term, right? And in commercial, it's typically not. You don't find a 30-year note. Typically, 10 is a long note in commercial multifamily. So to kind of frame the reference, right? Not hard money, not 30-year loan. It is 30-year amortization, but 10 is long in commercial, and it's bridge. And if you can find them stabilized, you get this agency debt. Well, those properties that I want to get, may be very good on cash flow. We've bought stabilized properties. We've also bought properties that are not stabilized. And the way we do that is with a bridge loan. And the bridge lenders want to see your plan. They want to see your plan from taking a quote. That's a quote unquote distressed property. So in single family, it's like it's distressed. It needs a lot of work and the plumbing and the foundation. And, I got to do this whole remodel. Well, in distressed and commercial, it's like, hey, this property's at 70% occupied. Should be at 90. What's going on? Well, maybe the old owner didn't have enough money to do any interior renovations, or the work orders are, it all not done, or maybe the boilers or the chillers are, that people don't have hot water in the building because the owner hasn't fixed it and everyone's leaving, and maybe there's, all these different things. You can imagine an apartment complex or what are they, just a bad landlord. So if you can show the plan that says, I'm going to borrow some money from you, the bank, and I want to borrow an extra 1.5 million or 2 million bucks on top of it. I'm going to spend this money for all the deferred maintenance, fix the boilers, fix the chillers, or, fix the roof. It's leaking, whatever it is, fire, or just, I'm going to interior unit renovate all of the 100 units. That's where I'm going to spend my money. By the way, I'm putting better sign, putting landscaping, fixing the parking lot, doing all that stuff. And I'm going to spend that money, but now we'll be able to get from $700 rents to $900 rents. Well, that $200 rent increase is massive when you're talking about a couple hundred units. So the banks like that plan. And in fact, they'll give you interest only for typically like a 3-year period with a couple of 1-year extensions. And they may charge you interest only for 5 years. Now, what that means is on your pro forma, on your underwriting, when people are investing for cash on cash returns, your cash on cash is better if you're not paying the principal down. So you may be able to borrow money at a pretty low rate, which still, mind boggling. It's non-recourse also because it's multifamily. So and the hard money side of it, it's higher interest. On the bridge, it's higher interest. It's a shorter term. So you gotta do your plan. You got to get out of there before that time. They'll still take your property if you can't make it happen, but it's, non-recourse, which is, no, I don't owe $10 million, or I don't have $10 million over my head. If you follow the rules and do that, then what you're risking is your time and your investment seed. But like in single family, you're going to lose your time. If you lose a deal in single family, use your time, your investment seed, and you owe the whole loan amount on top of that. Where in multifamily, it's just your time and your seed, which it's a lower risk. It's a risk adjusted return. But anyways, hopefully that helps a little bit.
Okay, yeah, that's great. And how do you go about actually the initial like pre-approval let's say for a $10 million property? So how do you make sure how do you secure that from a bank? Let's assume it's stabilized.
Well, there's a few rules, right? And just to demystify it a little bit, it's $10 million deal. Let's say they give you 75% loan to value. They'll lend you 7.5 million out of the 10 that's needed, which just even of itself, I think most people miss this. That's just crazy. We're buying a business, a $10 million business. Try to go any bank for any business model and tell them, hey, I'd like to buy this new business. Can you give me $7.5 million for a loan? Try to do that as a startup, raising capital for venture capitalists. It's just not going to happen. So anyways, just even that is nutty. They give us $7.5 million. So we need $2.5 million for this loan. We gotta have that money, right? And let's say it's $1 million of renovation. So there's a $3.5 million that we need to raise. That's one of the hurdles, mental hurdles sometimes, or real hurdles. Either way. On the loan though, that's 7.5 million. You need a general partner team. So if there's 4 of us, 5 of us, if there's 3 of us, you need the net worth of the general partner team equal to the size of the loan. So if the loan amount is 7.5, all three of you have to be, if there's three people, you have to be 2.5 million, 2.5 million, 2.5 million, or one person can be 7 and the other two can be 250K net worth, 250K net worth, and that qualifies. You also have to have 10% of liquidity. So if the loan amount is 7.5 million, you're going to need $750,000 of liquidity in your accounts, whether it be cash or marketable securities or stocks or something like that, funds that you can tap. And the banks are going to look at your personal financial statement. That's how they're going to do the credit. Everybody has to have a minimum of like 650 credit. So that's kind of cool too. I go 650. I don't even think you could buy a house with that, but you buy a $10 million building with it. So that's what you, the main thing to think about is, oh, and also experience. The bank wants, you can't have 2.5 million, 2.5 million, 2.5 million, 7.5 million net worth and 750K cash and get a loan without someone that has experience on that deal, even if you're high net worth and high liquidity. They want someone who's already done this and signed on some loans, been in the deal, been in deals. One is kind of that minimum, but you really should have 2 or 3. And they want it local to the property. So an hour and a half to 2 hours from the property, that's good experience. So the limiting part of it is, or the limiting belief that I had, I didn't even know those rules. I just didn't think I could buy $10 million. As soon as I knew the rules, I still had the limiting belief like, well, shoot, I don't have $7.5 million in net worth and I've never done a deal. So how am I going to get one? Right. Any lack or deficiency you have in that, you just partner with other people. When you partner with someone who has high net worth, high liquidity for a key principal role, when you partner with someone who already has experience, when you partner with people that already have what you're lacking, whatever that may be, experience, money, net worth, cash, liquidity, whatever, you can go put them on your team and we can go do a deal together. And that's kind of how the world works in the syndication side, is we're fulfilling that lack of, and we're making it happen.
Awesome. Makes sense. So we are already over time, but we have a question on the chat from Peter. So can you talk more about bridge? So let's, I think, make it the last question for today. So can you talk more about bridge debt, pros and cons? Also, would you do a bridge loan for a 5-year term of interest only, 3 years, and 2 1-year interest only? It's kind of technical. Maybe you can read it.
I can. Let's see. Yeah. So can you talk about the bridge debt, pros and cons? Well, bridge debt is higher risk. Let's take it one at a time. Bridge debt is higher risk than agency. It's a shorter period of time, and the reason, and a little higher interest. That's because they're lending their money on a property that's not stabilized. So if they do the deal with you and you can't stabilize it, their money's out there. The kind of the area that bridge lenders, the wrong bridge lender, put the reputation on a few of them, which is they'll absolutely take your property and make it difficult for you to get your money that they were going to lend to you. Because if you do a lot of the work and you go buy it at a good deal and you put your seed money down and they take the property, now they're in the deal at a really low price and they'll finish that plan themselves. So that's a real risk, and that does happen. And as I've heard bad stories about the wrong bridge lender, you want a good loan broker to kind of help you, in this process. But the way they make it hard is they'll say, hey, we'll lend you this on this same example. I talked 10 million, 7.5. They may lend you the 7.5 million for the loan. Then they may lend you another 1.5 million for the renovation. So now I don't have to raise 3.5 million. I only have to raise 2.5 million. And the bank's going to give me that. Well, that sounds great, except that they do it on a draw process. So that draw process is you do the work first, spend $100,000 at a time. And once my inspector goes out there and I see the work's completed, then I'll reimburse your $100K, and we'll do that 10 times till we get to this $1 million, right? So if your budget's already tight and you may not have that cash, or the contractor wants his money now and you're fighting with the bridge lender on trying to get your money back. Well, they say it needs to be inspected, but you've got to, follow this certain, you can only have an inspector out on Tuesdays and Thursdays, but contractor only wants to come Monday. Whatever the case is, it's hard sometimes to do that. The wrong bridge lender will make it difficult, and they kind of put that pressure out there. That's the horror story of a bridge lender. So the big cons, right? The pro is, man, they're going to lend you the money for the rehab. It means less raised, means higher returns for the investors. If I don't have to pay $3.5 million bucks back, I just got to pay $2.5 million back at 16% return. But the bank's lending to me at 4%. Just do that's like the interest rate arbitrage, right? Because if we're borrowing from investors at 16%, it was like putting a renovation on a credit card, $3 million credit card at 16%, but the bank's going to give it to you at 4.5, way cheaper. So I want to borrow more of their money. It makes my investment better, gives us better returns. So that's the pro. And then you can buy a deal that's not stabilized, which means there's probably a great opportunity for forced appreciation. As soon as I pull this thing off, man, they were at 70%. I'm going to make it 94, 95, and I'm going to crush it. The value is way higher. So those are some of the pros and cons. And then would you do a bridge loan for 5-year term? Yeah, typically they're like 3 years IO. Well, they're typically all the years are IO. They'll start with a 3-year term, and you need to negotiate a couple of years of extensions in case you miss your 3-year window. And that's kind of how the extensions work. Hopefully that helps.
Awesome. Thank you so much, Ivo. So what is the best way for people to connect with you?
I forgot about this part, and I'm copying, pasting. Trying to find my little copy and paste right now. Let me, it's probably, my website is the easiest, but let me copy and paste right now. 5TCRE, this one. Okay, cool. I've got one link, that Linktree link. It has all the stuff. I did put my website there and my phone number and email address, and you can copy that up. I'm trying to spend more time on Instagram right now, and I'm spending a lot of time on Clubhouse. But that Linktree, we've got a meetup on Wednesdays at 12 o'clock. It's got the links to our podcast, 150 something shows. And then I wrote a book last year, really simple book on multifamily syndication. I think it'll help kind of for the basics. And then if you want to come and, talk to us about an investment, fill that top one out, 5tcre.com/invest. We'll set up a time, learn a little bit about your goals, and talk about either the current fund or the future fund. We're just about to launch another fund, which we're excited about. So it'll be round 2 for us.
Awesome. Thank you so much, Abel, for speaking today. And thanks to everyone for joining. Really appreciate it. Thank you.
Bye, everyone.
Hey, Stefan, can I ask one last question?
Yes, sure. Okay, go ahead.
Okay, thank you so much. I'm sorry. First, I just want to say thank you to both of you, because I've been contemplating on doing multifamily or doing single, and I feel like this webinar came at the perfect time. So thank you so much for everything that you guys do. My question was that, so I live in New York City, and I want to do multifamily, but not here. I want to do it in another state, and I feel like I'm very hesitant to get started. So I just wanted some advice from you as to, how it feels to do a deal out of state, being an active investor, like you said. So that was just something I wanted to know.
Yeah, I think the great part about multifamily syndication is exactly that. If you're passively investing, it doesn't matter if the deal's in your backyard or across state. You're doing your due diligence on 3 things: the team, the market, and the deal. And as long as you check those 3 things out, I think that's the beauty of multifamily passive investing. I don't need to drive by the property. I don't need to talk to contractors. I don't have to be out there. Y'all do the work. I'm giving you my money, make it happen. And it's literally, that's the way it's built. And also, they take the risk because they're signing the loan, the active partners. And so it's good stuff. It's good stuff.
Gotcha. And then does it take time to, can somebody start off and do passive investing, or do they start off being an active investor first?
I like passive investing first. It's definitely a lot easier to get in. You put your money in, the barrier to entry is like $50K. And I know not everybody has 50K to invest, but the people that are, if you got 50K, it's like you need to jump in, especially if you have enough funds. You know, you're sitting on a few $100,000 or, you know, million or whatever. And I had a buddy that is sitting on a good amount of capital, $1.5 million cash, because he was worried about putting in the stock market. But I go, man, your money's just not working. None of it. It's like it's losing its value over time. So, anyways, if you have 50K though, you put it in a deal, and that's really what you need. After that, your due diligence. Look at the, you know, learn a little bit about market mechanics. This is like population increase, population growth, the corporations that are coming into the market, sub-market. Look at the average median income in the specific little sub-market that the deal is in, and then find out the track record of the team. How many deals have they done? Are they newer? Are they more veteran or tenured? Just because they're newer teams, I've interviewed some people on my podcast, and for some reason, their first ones are always like the biggest returns. They give away a lot of the equity to their investors because they think they have to, and then they crush it, and then they make a little bit of money. So I think that's, you know, I was kind of in the same mindset as like, oh, I got to give it all away to get in it, and now, you know, like trying to lean back a little bit. But and then the more tenured teams are like, well, I mean, the past does not predict the future performance, but it's kind of hard to argue with the track record that shows they've done pretty well. So, and then the actual deal, you know, do you like the deal? The numbers look good. Can they pull off their plan? Can they push up their rents like they're saying? You know, if they can do that, then you're like, yeah, I'm ready. I'm in. Let's go.
Gotcha. But would you still need 50K to start if you're raising capital?
If you're raising capital, technically you don't need money to put in your own deals if you're a general partner. But I will tell you that it's probably a little hard to raise capital if you're not investing, or if you've never invested in deals passively or anything like that. But the lenders don't require all the general partners to invest. As a loan broker, what I'm looking for is, can the general partner team put 10% down of the down payment themselves, of the equity? That can come from one person, technically, if there's 3 people on the team. So you know, can you get it in a deal with no money? Yeah. If you jump on a team and they work with you and they understand, hey, I'm not investing, but I'm going to raise capital, I want a piece of it, you could get in a deal with no money.
Got it. I look forward to reaching out to you. Thank you so much for answering my questions.
All right.
Awesome. Thank you so much. Thanks, Abel. Appreciate it. Have a good night, everyone.
All right. Bye, everyone. Thanks. That was great. Great talking, everyone.